On Tuesday, December 13th, we saw the much anticipated release of the latest CPI data. Now, the number came in lower than expected at 7.1% year over year versus an expected 7.3%. The ramifications for a slowdown in inflation was immediately evident as the S&P 500 rallied almost 4% in the first minute, and two-year yields went from 4.38% to 4.17%. The Fed funds futures curve also reacted swiftly, changing expectations from a 5 to 5.25% terminal rate to now a 4.75% to 5% terminal rate. This, according to the CME FedWatch tool. Now, the story is simple. The market was craving evidence that the Federal Reserve's year-long battle with inflation is nearing its conclusion. And although it's obviously a long road ahead, this was a big step. Expectations strengthened for a 50 basis point hike at the December 14th meeting with an 80% probability, up from a 74% probability just before the CPI. The next big data point that traders will be watching is the December 15th release of retail sales. The last read on this number came in higher than expected, but sparked a debate as to the role that inflation had in the elevated number. If a trader believes that the changing macro story could push two-year yields lower from here, they could express that by selling the December micro two-year Treasury yield futures contract at 4.14 and target a move to the early September highs and psychological level of 3.50. A stop for this trade could be placed above at 4.40. Now, this trade could make $640 if the target is reached and risks $260 if you're stopped out of your level. Now, if a trader believes that yields could rise from here, they could express that by buying the December micro two-year Treasury yield futures contract at 4.14 and target a move back to the November highs of 4.70. A stop for this trade could be placed below at 3.80. This trade could make $560 if the target is reached and risks $340 if you're stopped out at your level.